Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the forthcoming Bank of England interest rate decision. It comes on Thursday, the 1st of February. And certainly this comes in the midst of a particularly volatile week where we see earnings reports from a whole host of the big seven, or so-called magnificent seven. We also see the Federal Reserve interest rate decision. We see the payrolls of US jobs report on Friday. And in the midst of that, we see this Bank of England rate decision. I wanted to take you through a few of the key factors that I'm looking out for and where we could see potential volatility, and then a look at some of the key markets associated with the UK and how we could see them move in the wake of this announcement. So first and foremost, let's take you through a few different metrics. This is the breakdown on current expectations from the Bank of England, or for the Bank of England. It's market expectations. So this is from LSEG, or London Stock Exchange Group, through their Icon platform. In terms of this meeting, by and large, markets are pretty much saying we're not going to see anything in terms of a movement on that headline rate. 98% chance that we see them hold this time around. That shifts to 84% for March, and then things really start to get interesting in May, where essentially markets are seeing it as a coin toss, 49% chance of a pause, and then essentially the 51% associated with a rate cut. So really it's that pricing around the May meeting that I think we're likely to see a lot of the conjecture around this meeting center upon. If we see an increase in the expectation of a rate cut, then we're likely to see some weakness in terms of the pound. We're likely to see some upside in terms of the FTSE 100, and vice versa. If we see them really push back against expectations of a rate cut for that May meeting and push it further into that June meeting instead, then we could see the inverse of that. In terms of where things stand from an economic perspective, this is a breakdown on the UK inflation outlook. A few things to note here. First and foremost, 4% inflation for the UK is relatively elevated if you look at it compared to its peers. Nonetheless, if you look in terms of the middle section of it, we can see here that when it comes to February, March, April, May, that's where these four big chunky readings are. And when they drop out, we're likely to see that headline inflation rate fall, not like a stone, but in a pretty dramatic manner. So be prepared for some pretty massive disinflation over the course of Q1 moving into Q2. And really, the question mark that we're asking around a lot of these central banks at the moment is, are the central banks going to need to see a move back down to 2% for inflation before they act? Or are they happy to just say, hey, we've had 6 months of inflation that is essentially on a pathway to 2%, i.e. 1% cumulative over 6 months. And that is enough for us to say we're pretty much on a 2% pathway and therefore we will cut. Part of that is going to come down to the economic health of the region. If we're seeing suffering on the economic side of things, the central banks are likely to want to pull the trigger sooner than an economy that's holding up relatively well. Now, the US economy is holding up relatively well, but markets still think that we could see a rate cut in March. That's where I've got some question marks around. The UK is an interesting one as well, because if we look at the third section of it below, we can see that the annualized figures, so the 6 month annualized, i.e. if you take the last 6 months, what pace are we on? And then the 7 month, the 8 months, they're all around about 2% or lower. So for an extended period of time now, we've been tracking at a rate that is well below that 2%. And that points towards the possibility of the Bank of England acting, quite frankly, whenever they want, because they could justify a rate cut very, very soon, just on the fact that we have now for a prolonged period of time been tracking at a rate that is below 2%. And if they wait for it to actually hit 2% and then they start cutting rates, we're likely to see, as you can see here in terms of the 122, 117 readings, we're likely to see them go well beyond that 2%. And move into figures that perhaps they might be concerned about inflation being as low as that. I don't necessarily think it's too much of a problem because, of course, we've seen inflation well above target for a long period of time now. So being able to drive down that price growth for a bit might be a benefit. But I do think that there is a cause to be able to say the Bank of England could move sooner than when they actually hit that 2% target. The thing is that if you look at the breakdown from the December meeting from the Bank of England, we saw 6 votes in favor of a hold, which is what happened, and 3 votes in favor of a hike. So further interest rate upside. No votes in terms of a cut. So as it stands, a month ago, we were in a position where essentially the Bank of England still had 3 members that were talking about the possibility of raising rates further, despite what I'm showing you here. So the Bank of England at the moment certainly don't look to be in a position where they're desperate to cut rates swiftly. And that's why when we look back at the expectations, you've got that 50% chance of a rate cut in May. So people aren't really that convinced that we even see that rate cut in May, by which point we're likely to see, as you can see here, that February, the March, and the April figures stripped out. And that could see us move very swiftly towards that 2% target. So I think that there's a good chance that we do actually see that those expectations around that May meeting actually heighten. Now, in terms of the economy, we can see here that the comparative in terms of the PMI figures do point towards a relatively strong UK economy. And that comes down to the fact that we're heavily reliant on the services sector. And generally, it has been manufacturing that has been weak and services that have been relatively strong. And put that all together, and you put together the fact that the UK is heavily reliant on the services sector. And you can see here 52.1 for the December composite reading for the UK, in a pretty healthy position. This provides the basis for the Bank of England members to be able to say, well, look, we can hold off as long as we need to, as long as the economy is in relatively rude health. We want to drive inflation down, and we don't want to see a resurgence. So they could hold off for a little bit longer. And certainly the terminology and the outlook from the Bank of England is going to be really key. Are they looking to cut rates anytime soon? Because they're not necessarily being forced into it, as you can see here, in terms of an economic deterioration. Or are they concerned about moving below that 2% target? Maybe they're not. And so the outlook in terms of rates will be really interesting. And certainly, because of the fact that we've got, let me just take you right back to the first slide, because we've got that essentially 50-50 coin toss for the main meeting. That's got to shift in one direction or another as we get closer to the meeting and markets essentially start to gain confidence with what the next move is going to be from the Bank of England. So the shifting around about those expectations for May will likely be a core driver of volatility. Talking of volatility, I just wanted to show this chart. Is something I've always looked at over the years, but it essentially is the services sector, which of course is very important for the UK economy. The PMI number for the services sector overlaid against the pound over against the US dollar. So cable against the services PMI. Generally, we see them move in relative lockstep. The strength of the services PMI reading of late has pointed towards a possibility of further upside. And certainly if we are moving into a year where central banks start to ease and equity markets do well, that likely would push further upside for cable, because it's a dollar weakness story, much like the dollar strengthened at the time when everything felt like a big crisis. And now we're in the opposite position, essentially. And let me just show you that in terms of cable itself. This is cable on the daily time frame. This is the weekly chart. Now, the weekly chart, we were talking about the possibility of further upside if we're looking for further strength from an economic standpoint, certainly as we go throughout the year and interest rates are cut and the economy stimulated once again. That points towards the possibility of a long-term picture on this weekly time frame of us seeing this chart moving higher. But at the moment, you can see here that we've moved out of a phase of bullish sentiment and conviction and into one which has been dominated by indecision. You can see, whilst, week on week, people might say, the pound's moved higher or the pound's moved lower. We haven't seen conviction since the early part of December. And so we're really waiting for some sort of breakout from that. The daily time frame shows you exactly that. We've essentially got this sort of descending triangle formation at the moment, lower highs, flatlining lows. This could be some sort of topping pattern if we were to see the economic picture deteriorate in a meaningful way, or if we start to see the tech stocks really underperforming in terms of their earnings and the equity markets start to roll over, if we suddenly saw a resurgence in terms of energy prices because of everything that's happening in the Middle East. These are the kind of things that would likely see this market roll over and the US dollar coming back into strength. But for the time being, it seems like as we're moving lower, there's a good chance that this is just going to continue in the recent vein. So we could see some downside, but I think that we'd likely see this market finding support once again. You can see here this lower high coming into play, and then we start to see the lower lows. So near-term potential downside, and that downside could continue if we see the Bank of England coming out with a relatively dovish stance. Remember, last time around, we saw 6 votes for a hold, 3 votes for rate hikes. How's that going to shift? Maybe it's going to be a case of 9 votes for a rate hold, and some of the sentiment and talk is around about preparing themselves for the rate cut. Maybe that's going to be enough for the market to think, okay, great, we could see the Bank of England cut rates relatively soon. I do think that we're on track to move towards that target before the end of the first half, and therefore it's a question mark of how quickly and how much before we actually hit 2% do the Bank of England actually want to take action on this. But certainly, as things stand, we're in a symmetrical triangle formation. That long-term picture, I think, looks relatively bullish. But if we were to break through this support structure, you're looking at the potential for a near-term pullback for this market. But like I said, that key support level of 126, 124, it at the moment looks like it could hold once again, and we'll just continue within this holding pattern. So potential for the bulls to re-enter around about that support level. Finally, I wanted to show you things in terms of the FTSE 100 regaining ground coming into this meeting. But if you look at price action of late, it has a striking similarity in terms of that indecision that we're seeing from the likes of cable. We're seeing it once again in terms of the FTSE 100, with this market essentially swinging up and down and not necessarily going anywhere. Now, bear in mind that the FTSE 100 is the kind of market that holds up relatively well comparatively against other markets when markets are in free fall. But when markets are doing relatively well, i.e. you're seeing record highs for US indices, we generally don't necessarily see the FTSE fare as well. The strength that we have been seeing of late actually tallies up with the strength we're starting to see in energy prices. And so commodities are going to really be key going forward. If we saw dollar weakness and we saw strength in terms of some of these major commodities, then we could see mining stocks and oil and gas stocks fare well, and that could be a benefit for the FTSE 100. So for the near term, we're rebounding, but I would be careful around about this area of resistance. We've got this zone where price action has tended to roll over from 77.23, 77.61. If we come into that area, unless we break through it, look out for the potential for some sort of long upper shadows, long upper wicks that could point towards another rollover for this market, because as things stand, we remain within a zone of sort of consolidation that has really dominated over the last 6 months. So unless we see otherwise, expect more of the same. Thanks a lot for checking out the show. I'll be keeping an eye out for this event, but also following it up with a number of different videos for the likes of the non-farm payrolls. I've also provided one for the FOMC meeting. So I hope they're useful for you guys, and good luck trading around these key events.